Well, it looks like we're having a little technical trouble with Art, and he should be popping back in here any moment. I'm looking forward to meeting with Art today. You are with Art Alvarez. I'm Jeff Harrison, and I'm like the Ed McMahon for those of you who remember the Johnny Carson show. I'm just filling in. I'm on the couch, and I kind of take care of behind the scenes. And every once in a while, I'll ask Art a tough question. He is obviously having some challenges. Here he comes. He's in the green room now. Yep, they've just powdered his nose. He's ready to go. Hi, Art.
Hi, Jeff. How are you?
Did you get camera shot? All of a sudden, you disappeared.
Yeah, I was trapped in, like you said, I was trapped in the green room.
Well, welcome. I'll step out and I'll keep an eye on the technical side.
Okay, thanks, Jeff. Well, good afternoon, everyone. Welcome to this week's Mortgage Minute. My apologies, we had a little technical difficulty there. That's why I was not quite up on the screen here when the show started. Here we are, mid-October. Halloween fast approaching. October is a great month. I love October. Football started again, of course, not a month ago, and now we got October baseball, which is always terrific. It's just a great time. So, and overall, things are looking still pretty good in the mortgage market, despite the fact that everybody got caught surprised to a great degree in terms of what happened to mortgage rates after the Fed meeting in mid-September. So let's go ahead and take a look at where we're at right now. We always like to start with a mortgage rate update. And so Jeff's going to pull up our rate grid right from the homepage of our website. And you can see there that rates have trended up since mid-September. We're generally up about 0.5% with most programs, but we're still in a pretty good range, certainly a lot better than we were in a month or two ago. In fact, we're getting ready to close a second home purchase for a client who I was first working with on a transaction back in June, July, when the second home rates were in the sevens. And so now we're at least in the low to mid sixes. And you can see that on the rate grid for a conforming 30-year fix with a good credit score and decent down payment size, 6.125 and no points. FHA, VA still hanging in there in the mid fives at about 5 5/8. And those temporary buy downs are still terrific. I mean, a 3-2-1 buy down where you can get a first year rate at 3 3/8. Isn't that what everyone's waiting for? So again, if you're looking to buy a home and contemplating making an offer below list price, talk to me first. Let me give you some numbers on how to show you that you can get a better deal by using that concession you're asking for in a temporary buy down rather than just a lower price. The other thing I would want to point out, we're going to talk about this in a second, is the equity loan rates. They're terrific right now. And we're starting to see a lot of action with equity loans, which of course have been fairly popular for the last year or two with first mortgage rates up. But what has happened with equity loan rates recently has been really, really good. So why are we at where we're at? Well, we had a big move today in the 10-year bond yield. Yesterday we were getting back close to 4%, maybe looking to go under 4% on the 10-year Treasury bond yield. And again, a reminder, anybody new to the show, I always point out that your best barometer to track to see where mortgage rates are going is look at that 10-year bond yield. And you can see there the chart for the last 5 days. In fact, interesting about this chart, last week, Jeff and I discussed the fact, is there a pattern where the 10-year yield tends to drop midweek? Well, I concluded that the evidence of that is inconclusive. And yet here we are this week with another example of how the 10-year bond yield did drop midweek. And what was going on there was we had a pretty light economic calendar. The jump in the yield today, where we were at like just over 4 yesterday and up to almost 4.10 today, is retail sales. So let's go ahead and talk about that a little bit in terms of what's going on with the economic calendar. This week, as I mentioned, the overall calendar for economic data points was very light. There was not much going on early in the week at all. Today was really the first day of the week where we had any economic data points released that can tend to move the markets a little bit. One was the weekly initial jobless claims, that's unemployment claims, forecast to be 260,000. Well, it came out this morning at 241,000. So that's below expectation. That, of course, suggests that the labor market is firming up. And last week's 260,000, which at that point was looked at as a, hey, wait a minute, maybe more people are starting to file for unemployment. Well, that backed up today, dropped down to 241,000. So that's at least a somewhat of a soft signal that the labor market's still hanging in there pretty well and is not, falling off a cliff. But the big move today was U.S. retail sales. They were up again. up more than forecast. 3% growth was forecast for September. That's why after a relatively weak 1.1% in August. Well, it came out at 0.4% this morning. So again, to use the media's favorite term these days, that was a hot number, hotter than expected. So of course, what happens? The 10-year yield jumps about 8 or 9 basis points from about 4.01 to 4.9%. So ergo, mortgage rates generally followed in that direction as well. So we're not, at the point yet where we can look for or hope for getting back under 6. That looks like it's a little bit out of reach, at least for now. However, overall, it is still the case, the financial markets, there are betting markets for what the Fed's going to do at each of their meetings as to what they're going to do with the Fed funds rate. Well, as of right now, even with today's jump in the retail sales and the bond yield, the betting markets are still looking for a 0.25% reduction in the Fed funds rate in November and another quarter in December. So that would still be very good news if it occurs. And I think if anything else we've learned, or anybody watching the show has learned, that those reductions, should they occur, does not necessarily mean that you're going to see an improvement in long-term mortgage rates. We learned that last month with that 0.5% reduction, and mortgage rates went the other way. They went up 0.5%. But there is a certain mortgage type that has benefited from the Fed action we just had, and will benefit from the Fed action in November and December if it comes true. And that's what Jeff and I are going to talk about now.
Hi, Art. Welcome
Hi,
back.
Jeff. Yep.
Yeah. This is one of those things. I know that often it feels like you're delivering bad news with economic this, economic that, but really, did all the mortgage rates go up, or was there any good news in that? That's kind of the topic of today's conversation.
Yeah, exactly right. Yeah, I mean, long-term mortgages disappointed everyone after the Fed meeting because they went the opposite direction of what the Fed announced. They didn't go down 0.5%; they went up 0.5%. But as we talked about in the last week or two in the program, we try to make our viewers understand that it's not all about the Fed, in a vacuum. There's much more that goes into what happens with mortgage rates, and what's been happening since the Fed meeting was strong numbers, strong data points as it relates to the labor market, and then hot numbers as it relates to inflation. So that's why we kind of went the opposite direction of where everyone was expecting after the Fed meeting. So,
well, one of the questions is, what happened with mortgage applications after the last Fed meeting?
Yeah, that's I kind of chuckle at that because right after the Fed meeting, when they did drop the Fed funds rate at 0.5%, it was interesting how the markets, and particularly the financial media, grabbed onto that as a sign that we're now going to start a good positive trend of decreasing rates in the near to mid future, and that was going to create a boom, in particular on the refi side, a new refi boom. Because of what the Fed action, because of the Fed action that did occur. Well, one of the things about the mortgage market is it really is extremely interest rate sensitive. And so what's happened is, after the media was pointing out that right before the Fed meeting, mortgage applications were up somewhat on the purchase side, but in particular on the refi side, because of all the enthusiasm about, okay, we've hit the plateau and we're now going to be riding that downhill ski slope type of a trend where mortgage rates are going to keep falling and falling and falling. And so now's the time to refi, and we're going to be, being hit with a big refi boom. Well, since the Fed announcement, and when those bond yields moved up and therefore mortgage rates moved up, it's completely changed the picture. Mortgage applications now, since the Fed meeting in mid-September, have actually dropped quite a bit. Overall, I mean, to the tune of like 20-25%, all because of the fact that after that Fed meeting, long-term mortgage rates did not continue to go down. They actually reversed direction. They've gone up. And again, the mortgage market is extremely interest rate sensitive. So there's almost always a direct correlation to where that move occurs, or where it occurs in terms of how much, and then what happens to applications. And we've definitely seen that. In fact, if I want to sort of use a exaggerating adjective that I see the media do all the time, some would write that mortgage applications have plunged since the Fed announcement. I think it's a little bit of an overstatement, but it is true that mortgage applications have fallen a little bit significantly since the announcement.
Do you think, just a little follow up on it, do you think that all the, it's like almost Jerome Powell has become this rock star. Anytime he says something, it's almost like a Kardashian, walking down, and you got to get a picture of him because it is so rate sensitive that they're just jumping on every opportunity to do this. And the whole market, because of the media, the way it is, we're just hanging on every word thinking that's the next thing.
Right. Well, and that's particularly true when you hang on the next word as it relates to headlines. We've talked a lot of times about beware the headlines. So many people, I mean, the consumer, the general public, that their attention span is so short that a lot of folks just are driven by the headlines, and they don't read the detail. They don't read the data. And I think I've commented before, when you see news stories, particularly in the financial area, a lot of times there'll be a reference to how many minutes of a read it is. And my theory is, when somebody sees an article that's about the financial markets, and if it says a 10-minute read, well, you're going to lose half your audience right there. They're going to look at the headline and move on. So that's an important thing to understand, is that you got to read the detail to really grasp ultimately what's going on. And in terms of the mortgage applications, the sensitivity from a move in mortgage rates is relative to, depending on the type of transaction. Since the Fed announcement, mortgage applications for purchases have dropped. And again, we're talking national numbers here, but they've only dropped about 7 or 8%. Not horrible, not a disaster, but certainly they've dropped. The refinance side, on the other hand, the mortgage application activity has dropped in the range of 26 to 27%.
Wow.
Now, why would you have that divergence of reaction to the higher rates depending on those two transaction types? Well, the answer is relatively obvious. If you want or need to buy a home, and particularly if you're what we call a situational buyer, we've talked about weeks ago on the program, where you have a need, where you have to move. You've got a job promotion, your job relocation, or you inherit a house and you and your family don't want to keep it. You need to sell it. Those kind of things. So what happens is, on the mortgage side, or I'm sorry, on the purchase side, that'll be a little less affected by a change in rates versus a refi. Refi is more of a discretionary transaction. 0.5% in rate can make a big difference if for your refinance goal. And so that's why you see that divergent effect of the higher rates between a purchase and a refi. So yeah, the refi boom definitely has dissipated. It's back to there's more activity than there has been, but we certainly have not gotten back to the heyday of a couple of years ago when refinancing was off the charts.
Is part of that because of the fact there's still this the thought that comes, the glob of people who have homeowners and they still have those low rates locked in, so there's no reason for them to refinance at the rates they are currently?
That's exactly right. And of course, when it comes to refinancing, there's two basic types, right? I mean, there's what we call in the industry rate and term. That's where you're simply trying to get a new loan to replace your existing loan, and you're simply trying to reduce the rate. You're not looking to get any cash out of the transaction. So we call that a rate and term refinance. The other primary refinance type, obviously, is cash out. You've got a ton of equity. You've got a mortgage on the home now. It's probably got a very low rate because you refied in 20 or 21, but you want to get to that equity. And so a cash out refinance is the other major transaction type for a refi. And so to the extent that there is refinance activity, I would say it's predominantly a cash out refi situation, because of so many homeowners with so much equity, they want to tap into that. Now, the rate and term refis that are occurring now are really for people who bought maybe a year, 18 months, 2 years ago, where they probably ended up, again, they were probably a situational borrower. They had to buy a home, and they probably got a rate that's in the low, mid, maybe high sevens, approaching 8%. Those borrowers, those homeowners, a rate and term refi can benefit them now, even at current rates. But that's a relatively small pool relative to all the homeowners, majority of homeowners, as the media has talked about for months and months and months, this vast majority of homeowners that have these very low rates on their first mortgages. They want to tap into that equity, and that's why they're looking at the refi. And in some cases, depending on the relationship of the amount of cash out they want and the balance on their first mortgage, it may make sense to, yeah, give up that low rate on your first mortgage and get a new one at current rates where we're at now, because ultimately that cash out amount is so large relative to your existing first mortgage balance, it makes sense to give up that rate. Because if you go just the equity loan route, the rate on that, which is going to be higher, may overwhelm the rate on the first, so that your blended rate would actually be worse than if you just get a new first mortgage at current rates.
Makes sense. Well, Art, let's talk about what sort of mortgages saw lower rates after the Fed meeting. I know you kind of leaned into that a little bit. You kind of teased us at the beginning, but can you share with us that information?
Yeah, exactly. It's equity loans. What's happened after the Fed meeting, and the type of loan that has benefited from the Fed action are equity loans. What is an equity loan? It's basically it's a second mortgage. It's a way for a homeowner to tap into the equity in their home where they don't want to touch their first mortgage, because as we just talked about, you've got a very low rate on that mortgage. You probably refinanced it 2 or 3 years ago when rates were in the 2s and 3s. So the equity loan segment of the mortgage industry has benefited from what the Fed has done with the Fed funds rate. In particular, on the equity loan side, it's home equity lines of credit, the acronym being HELOCs. I think most people now know what a HELOC is. It's a pretty predominant term out there in the news world. So HELOCs in particular have benefited from what the Fed did. Why? Because the rate on those is determined entirely differently than a long-term mortgage that will serve as collateral for a bond, for a financial bond sold in the financial markets. A HELOC is going to generally be tied to the prime rate. The prime rate does directly correlate to the Fed funds rate. So what happened is, in mid-September, when the Fed dropped the Fed funds rate 0.5%, the prime rate dropped by 0.5%, went from 8.5 to 8. So if you have a HELOC, you may have gotten a year or two ago, you saw, or you should have seen, immediate impact on your rate by it falling by 0.5%, because the prime followed the Fed funds rate. So what we're seeing is equity lending, which was already kind of somewhat of a bright spot in the mortgage industry, it's getting even better because people are experiencing an improvement in their rate. And for those who already have a HELOC, and it's now becoming more attractive for a homeowner who's been on the fence about, do I refi my first, give up that low rate to get my cash out, or do I keep my first where that low rate is and then use an equity loan to pull the cash out? Well, now home equity lines of credit, HELOCs, are now more attractive because of that 0.5% reduction by the Fed. And of course, as I mentioned earlier, if we do see a quarter in November, a quarter in December in the Fed funds rate, the prime is going to drop with that, and the prime will drop to 7.5. So it's going to get even more attractive to have a HELOC, because that loan type is going to ride that improvement in the Fed funds rate.
Well, there are several types of HELOCs, and you shared off screen a little bit before we got started about a special one that you offer, and it's called the fixed line HELOC. What's so special about that, and why should we kind of take out our pen and paper and take some?
Yeah, that's a good question, Jeff. A fixed line HELOC is something we started offering here just within the last couple of months, and it's a very unique type of a HELOC. And we're having very good success with it in terms of, offering it to prospective borrowers who are trying to tap into their equity. Now, just as a basis of what a HELOC is in general, a HELOC generally has been historically a 30-year loan where you get a initial draw period that can be 10 years, and then your rate's going to be tied, as I mentioned, to the prime rate with some margin over the prime rate. Some lenders that margin over prime could be as little as 0. Some it's going to be 1 to 2%, depending on your loan to value and credit score. And the minimum payment per month is interest only. Although if you pay extra and reduce your balance, then you can redo the HELOC, because you can reuse the unused portion of the HELOC as that balance goes down. But that is a variable rate loan. HELOCs are variable rate loans, generally speaking, because they're tied to prime. And prime isn't fixed. It's going to change whenever the Fed funds change, as I just described. Now, of course, right now it appears that's a good thing, the HELOCs tied to prime should see some better rates as the Fed continues dropping the Fed funds rate. Although we now know they're not going to do it as much and as quickly as we previously thought. So that's been the basic idea with the HELOC. With the fixed line HELOC, it's a new program with a very unique feature, actually a couple of unique features. One is, as the name would imply, it's a fixed rate loan. It is not a variable rate loan. So you have the benefit of interest rate stability. You don't have to worry about being at the mercy of how the prime rate changes. Now, again, right now, optimism is that the Fed funds rate is going to be lowered multiple times over the next year or two. So maybe that's a good thing. But at times, like if you had a HELOC in 20 or 21 and you still have that HELOC, you saw that thing climb from 3 or 4% up to 8, 9, 10%. So a fixed line HELOC doesn't work that way. It's a fixed rate loan. And you can get this with a 30-year term, a 20-year term, or a 15-year term. So that's one of the benefits, stability of rate. Now, the draw period is only 3 years, not 10. But here's the really unique feature about the fixed line HELOC. After you get that loan, and of course you have to decide how much you're going to draw at close. And if you have an unused portion, you can use that. You can draw more later up to the credit limit or the loan limit that you asked for when you first got the loan. But here's the unique feature. As you pay down that loan, and when you make the payments, they're not interest only. They are amortized based on whether you chose a 15 or a 20 or a 30-year term. As you pay down that loan, your payment is recast the following month to a lower amount based on the outstanding balance. That is a unique feature for fixed rate loans that generally we've never seen in the industry before. So that's the kind of unique selling proposition of this type of a HELOC. It's fixed rate, so you don't have to worry about the rate going up in the future. And as you pay it down, you're going to be able to have your monthly payment requirement the following month recast lower because it's calculated off the remaining balance of the loan. And again, for that first 3 years, as you pay it down, you can reuse the unused portion back up to the credit limit. So that's a very unique feature of a HELOC that we've never seen before. And to go with that, the interest rates on this are actually very incredible, which I can talk about in a minute. But that's the unique idea with the fixed line HELOC.
It almost sounds too good to be true. Like you've said, you're betting with the house's money there. That sounds like a pretty good opportunity. But I'm curious, Art. This may be great for, let's say, people out there that are working right now. But what about retired people? What about seniors? Is there anything available for them?
Well, yeah, there is. And in fact, that's a good point, because one of the issues for seniors is that sometimes as you get more closer to retirement age, some of those senior homeowners out there who have a lot of equity, they have a low rate first mortgage, but they're running into some trouble financially. I mean, I'm encountering more senior homeowners that are, in some financial, stress, because they've got too much credit card debt. They've had a change in their income stream. Maybe they've had to, change jobs, or they retired from a job and they thought they would not have to work again. They end up having to go back to work. In fact, that's been a fairly big news item, that more and more, people approaching retirement age are having to go back to work because they're having some difficulty financially. And so we have now a product for that scenario. And when we say senior homeowners, by the way, the traditional reverse mortgage, you have to be 62. Well, with this second mortgage product, you don't have to be 62. You only have to be 55 or more. And what's interesting about it is it's specifically designed as a second mortgage for someone who owns the home, has a lot of equity, they have that low rate first mortgage that they're handling okay, but they need that additional equity. They need to pull that cash out because they either have some financial strain, like debt, credit cards, too much borrowing, consumer borrowing, or maybe they've got some delayed maintenance and repair items on their home, and they're having trouble pulling that equity out because they've applied for a HELOC and they got turned down because their credit score wasn't good enough, or because their debt to income ratio didn't meet the guidelines for a HELOC. This program, which is called a Home Safe Second, is specifically designed for that scenario. There's a couple of very interesting features about it. Number one is you only need a 600 credit score to be eligible. That's unheard of. You can't get a fixed rate second or a HELOC at a decent rate with a 600 credit score. In fact, you're not going to find any kind of traditional HELOC from a major bank, credit union, or mortgage bank, and get one at 600 credit score. It's just not out there. The other thing about it is if you're 720 or higher, you can actually get the loan based on stated income. You don't even have to document your income. And a debt to income ratio directly isn't really calculated for qualifying purposes. If your debt to income ratio is high, you can still get approved based on residual income, which is based on your family size, which of course varies. If there's 2 people, there's a certain residual income limit. If there's 3 or 4 or 5, then there's a different amount. So the point is, you can get access to this Home Safe Second loan without necessarily meeting a debt to income ratio requirement. You can have a credit score as low as 600, and you can still get qualified based on having residual income, even if you're a miss on the debt to income ratio. And this loan product just experienced a 0.5% reduction in rate as well, from 9.99 to 9.49. So that's good news for homeowners who are getting senior in age, 55 or older. With this product, they will see a benefit in terms of a little bit better rate, 0.5% to match what the Fed did. And then finally, the really good thing about this Home Safe Second product, it's a reverse mortgage essentially. So it behaves the same way. You don't have to make payments on the loan unless you want to. If you don't, yes, the interest accrues back to the balance. So it will grow over time, but you have the ability to make payments on it in whatever amount you want, as often as you want, and to help keep that balance from growing too much if you're concerned about it. So it's a great option for that 55 plus homeowner, where these other products I'm talking about, the HELOC with the variable rate and the 10-year draw, or the fixed line HELOC with the 3-year draw, and these really incredible rates where they're not able to qualify for that, the Home Safe Second is a great option.
Art, these are some really good signs, as you say. I just want to clarify one thing. So with the Home Safe Second and the rate reduction, does that only for new generated Home Safe Seconds, or is that like a home equity line of credit? It affects the balance, or no, the payments going forward.
No, that would be for new applications, because one of the things about the Home Safe Second, it's kind of like the fixed line HELOC. Where when you get the Home Safe Second, it's not like a traditional reverse mortgage where you can get approved for a certain loan limit and then choose to set up a line of credit where you can draw on it, gradually or occasionally. With the Home Safe Second, it's more of a traditional fixed rate second. You get all the proceeds at once and then you're done. So yeah, in that respect, you're not going to, if you already have a Home Safe Second, you're not going to benefit from the recent reduction in the rate from 9.99 to 9.49. And what's happened is, I've had a couple of cases where somebody they were 55 plus, they were interested in the fixed line HELOC, and we determined they weren't going to qualify. So we had to go and look at the Home Safe Second as the alternative. The fixed line HELOC we're getting a lot of interest in it because the rates are incredible. I didn't quite cover it earlier, but let me give you a couple examples. In fact, I just priced one out for someone who wanted $200,000 for a HELOC, and they were very interested in the fixed line HELOC. Well, I could get them a $200,000 fixed line HELOC with no points at 7.174. I then pointed out to them, if they were willing to pay 1 point, which is $2,000, not much on a $200,000 loan. And by the way, that can be financed out of the proceeds, not out of pocket. That would lower the rate to 6.374. And if they were willing to pay 1 7/8 points, again on 200,000, that's about $3,850. They can get the rate as low as 5.674. for a 1.875 cost. Now, these are all 20-year terms, which I would, by the way, suggest a 20-year term is a great compromise between the 15-year term, where the payment starts to get up there, and the 30-year term, where the rate will be higher. A 20-year term is the sweet spot for the fixed line HELOC. And so, can you imagine? You're borrowing $200,000 as a second mortgage. Yeah, pay 1 7/8 points, comes out of the loan proceeds, but to have a 5.674 rate for a 20-year term, I mean, that rate's better than a current 30-year or even 20-year first mortgage. So that is a terrific, terrific option. And that's why we're seeing a lot of activity with the fixed line HELOC.
Wow, it's nice to see some good news coming out of the Mortgage Minute. I know it's, you're just reporting it as it is. You are only deliver. But, the
Right.
cool thing about it is when we started back in January, I remember these HELOCs were really close to 10%, like 9 point something.
Yeah.
And now, as you say, they're, when we looked at the rate grid, they're down in the low sevens. It's pretty exciting stuff. So that makes a huge difference. And then with these new products like Fixed Line Second and also the Home Safe Second, why wait? Why wait?
I know.
Makes sense.
Yeah. Money's
Makes
out
sense.
there. You got to grab it. Yep.
Well, Art, thank you so much. With that, I'll turn it back over to you and have a great show.
Okay. Thanks, Jeff. Okay, everyone, we'll move on to our closing question from last week. It was a pretty good one. In fact, something that we encounter and run into fairly often these days. Here's the question. When we got our last mortgage, we provided our tax returns. This was a bit of there was a bit of a delay at closing because the lender asked us to get a 4506 tax transcript from the IRS. Since we already provided our tax returns, why did we have to do this? Very interesting question. It does come up from time to time. In fact, fairly often. So let me kind of explain what all that is about. What's the reason for that? Well, first of all, understand that when you provide tax returns in a mortgage loan application, those returns are going to require what we call validation. Now, what is validation? Well, the basic idea is to essentially use some sort of tool. Typically, it's done through a third party to determine or to audit the tax return to make sure that the one provided for the loan file is actually authentic. So that's really what this is about, is validation as a tool to combat mortgage fraud. Now, in the old days, back when I first got in the industry, literally 40 plus years ago, I would say mortgage fraud, particularly in terms of representing income, was more prevalent than it is today. Mortgage fraud back in those days, I think, was a much bigger part of the overall fraud universe. I can remember, the scuttlebutt in the industry, sort of the unwritten rule was a lot of times self-employed people would have two sets of tax returns. One they would use to submit to the IRS to minimize their income tax liability, and another one they would use to submit to a mortgage lender to get qualified for a mortgage. And obviously those two sets of tax returns in most cases would be quite different. Those days are pretty much gone. And the reason is I think the industry has evolved and gotten much better in terms of process in validating the documentation provided to catch and eliminate that kind of fraud. In fact, I looked up some numbers, and in the second quarter of 2023, only 0.75, less than 1%, 0.75% of mortgage applications had some sort of fraud in them. That's only 1 in 134 applications. And it was typically seen more often in a purchase than a refi. Why would that be the case? Well, there's more pressure, if you will, to get qualified if you're trying to buy a house. And in some cases, you might feel compelled to kind of play with the numbers in terms of what you're representing and documenting to try to make sure you get approved. So it is the purchase side where you're going to tend to see more fraudulent things going on in terms of documentation presented to establish what your income is. And interestingly, the property type where mortgage fraud is the highest is in 2 to 4 unit properties, which of course is interesting because those are predominantly properties purchased and financed by real estate investors rather than owner-occupant borrowers. So the normal process is when you apply for the loan, the lender is going to order what's called a 4506C. It's called a request for transcript of tax return. Now, in most cases, that gets ordered soon after the loan file is registered. You sign your initial disclosures. That will be ordered by the lender. But from time to time, the IRS suffers a backlog. And then suddenly you're getting close to your closing date, in particular on a purchase, and the lender ends up admitting they never got a response from IRS. And of course, they usually point to a backlog as the reason that occurs. So then you have this, sudden last minute need to get that information. So what the lender then falls back on is they'll ask the borrower to pull the transcript themselves, because you know what? You can do that. Now, interestingly, they won't let you do that initially. They want to order it themselves and get it through the normal process. But When you get to closing, if the lender's been unsuccessful in getting the IRS to respond, they will then offer you the opportunity to get it yourself. So you can go on to the irs.gov website, and right there on the homepage, there's a link that says get your tax record. So you, as the taxpayer and the borrower, you can use that feature, click that on, and just follow the steps, follow the prompts, and then you can order your own transcript of your tax return. And the idea is they're going to then take that transcript. It's basically a summary of your return. They're going to cross-reference it to the tax returns you provided that are in the loan file that the underwriter made their approval decision on to make sure everything matches. And of course, if everything doesn't match, then everything comes to a halt, and it's going to require further investigation to make sure that the lender is using the right numbers. So good question. That's why it comes up from time to time. It can be a little bit of a hassle, although really IRS has done a pretty good job of giving the taxpayer the opportunity to get this information pretty easily. So keep that in mind if you ever run into that, or maybe just to experiment with it, try it yourself and see if you can pull your own tax transcript just so you can see how it works, and then maybe keep it on file in case you need it later if you're thinking about getting a mortgage and if you're asked to provide that at the last minute. So with that, we'll go to our closing question for next week. And this one's kind of interesting. And I think we've covered this, many months ago on our program, but I thought it would be good to go over it again because we've got one of these in process right now. I've heard there's a mortgage called a bridge loan that can help a homeowner close at purchase without selling their current home first. How does that work? Well, that's a good question. I'll let you know next week how that works. And no, it doesn't involve financing of the purchase of a bridge. If you thought that was the case, then I have a bridge to sell you. But no, that's not what it is. So again, I'll have the answer to that question next week, and it'll be on the house. So with that, that'll conclude our program for today. I want to thank you all for watching and listening to the Mortgage Minute. My name is Art Alvarez with Mortgage Works. Looking forward to seeing you next week. In the meantime, have a good weekend. So long. Take care.